Imagine it's 2005. Facebook is barely a thing. The iPhone doesn't exist. And Apple, just a cool computer company. Now here's the real question. What if you dropped $10,000 into Apple stock and forgot about it? Would you be rich? Or would you have just taken a crazy risk? Let's break it down. In 2005, Apple stock was trading around $1 split adjusted. $10,000 would have bought you roughly 10,000 shares. Fast forward to 2025, Apple trades around $180 to $190 per share. That $10,000 would now be worth roughly $1.8 million to $2 million. Yeah, millionaire status. That's over 18,000% return. But here's the thing, back then, Apple was risky. No iPhone, no App Store, just iPods and Macs. You had to believe in Steve Jobs when most people didn't. That's high conviction investing. Now let's say instead of Apple, you invested $10,000 in the S&P 500. Average annual return around 9 to 10% historically. After 20 years, your $10,000 would grow to about $65,000 to $75,000. Solid, safe, consistent, but not life-changing. This is diversification. Lower risk, lower reward. Apple, concentrated bet. Massive upside, massive risk. Now here's where it gets interesting. What if you used $10,000 as a down payment on a $200,000 house in 2005? That's leverage. Let's say property values doubled over 20 years, which many US markets did. That house becomes $400,000. Your equity? Potentially $200,000 plus. So your $10,000 turned into maybe $200K to $250K depending on mortgage paydown. That's a 20x to 25x return. Way better than index funds, still nowhere near Apple. But leverage cuts both ways. Remember 2008? If you couldn't pay the mortgage, game over. Stocks drop, you can hold. Miss mortgage payments, bank takes the house. Different risk profile. Now imagine you played it safe. You parked $10,000 in a savings account at 2% average. After 20 years, you'd have about $15,000. Inflation probably ate most of that gain. Safe, but losing purchasing power. So what's the lesson? Apple, high risk, insane reward. S&P 500, low stress, steady growth. Real estate, leverage boosts gains and risk. Savings, safe but slow death by inflation. The real question isn't, what if you invested in Apple? It's, would you have had the guts to hold it through crashes? Because investing isn't about picking winners, it's about surviving long enough to let them win.